Hi again, this is Dr. Mahmoud Al-Odeh, and in this video, I'll be talking about the MACRS depreciation techniques, and this technique is developed by the Internal Revenue Services. The MACRS is the required depreciation method used for tax purposes in the United States. To utilize the MACRS method, you will need to use the rate tables established by the IRS. So what we did in the previous techniques is we did calculate the depreciation rates. For this MACRS technique, which is developed by the IRS, we don't do the calculation for the depreciation rate. We use the rates that provided by the IRS. There are two MACRS methods established by the IRS. One is the mid-year convention rates, and the other one is a mid-quarter convention rates. For this, in this book and in this class, we will be using the mid-year convention method, which assumes that the asset is purchased in the middle of the year. And therefore, what you will see here, this method will allow only for half-year depreciation on the first year, and the remaining of that will go to toward the end of the life for that asset. The remaining first-year depreciation balance is considered and deducted in the last year of the recovery period. So if once I show you now with the rates, you will notice that there is an extra year, an additional year added to the recovery period. So for example, if I said an asset with a 5-year recovery, you will see 6 rates in that table. And this is just to capture the full depreciation in the mid-year convention method. All right, let's take a look into the first table that developed by the IRS, which is examples of assets classification and their recovery period. So in this table, you will see some of the assets and what is the recommended recovery period. So if you have a small tools, tractors, horses, specialized manufacturing devices, that recovery period should be 3 years. If you have computers, autos, light trucks, small aircraft, construction equipment, research and development of property, that would be a 5-year recovery period. And now office furniture, fixtures and equipment, commercial aircraft, and most machinery will fit into the 7-year recovery period. So this table will help you to identify what is the recovery period for each asset. Now for this slide here, what you will see the rates, the depreciation rates if we have an asset for 3 years, 5 years, 7 years, 10 years, 15 years, and 20 years. And what you will see here, for example, let's take the first column here on 3 years. We have a 3-year asset. The depreciation rate on the first year would be 33%. The second year would be 44%. Third year would be 14%, and the fourth year is 7.41%. As I mentioned earlier, as you see, there are 4 rates here because we're using the mid-year convention depreciation rate. Now, talking about the real estate property, we have the IRS provided a 4-year recovery period for real estate. And the rates for that on the first year would be 1.39%. From year 2 to 39 would be 2.56% depreciation rate, and on year 4 would be 1.17%. And we do the same equation that we used in the past techniques, which is the depreciation value equal to the first cost times the depreciation rate, and the book value would be the book value minus the depreciation value for that asset. All right, let's take a look into the first example on applying the MACRS. And this is where taking us into example 3. In example 3, we have an asset of $400,000 initial cost, 10 years life, and $40,000 as a salvage value. What we need to do, we need to conduct the depreciation analysis using the MACRS. All right, in this technique, please note that the salvage value cannot be used in the MACRS. All right, let's switch to Excel and see how we could conduct this analysis using Excel. All right, example 4, we started with a 400,000. So what we did, we identified, or it's already given to us that this asset will last for 10 years. So we go to the IRS table of the rates and you select the 10-year asset and you copy these depreciation rate of 10%, 18, 14, 11, etc. You bring it to here to your Excel, and then you start calculating the depreciation value. And the depreciation value would be by multiplying the book value times that rate. So in here, for the first year, what we do, we multiply the 400,000 times the 10%, and that will give you a 40,000 depreciation value on by the end of year 1. Now, to calculate the book value by the end of year 1, you subtract the 400 minus the 40, and that will give you 360 as the book value by the end of the year. All right, let's move on to the year 2. Calculate the depreciation value. Again, we multiply the book value on the initial cost times the 18%, and that would give you a 72 depreciation value on that asset by the end of year 2. Find out the book value for this asset by the end of year 2 would be 360 minus 72, and that will give you 288. The same thing you do for the following years, just by multiplying the initial cost of 400 by the depreciation rate provided by the IRS to find out what would be the depreciation value for each of the years. And then you will find out that the book value by the end of year 11 would be 0. So this is the idea of the depreciation, is to reduce the asset value to 0 by the end of its lifetime, or by the end of economic life, as we discussed in the previous chapters. All right, so and that would give you the book value. So the question could be, what would be the book value in year 5? That would be 147 on year 5, 13,120 on year 10, etc. So again, what we did here for this technique, we used the IRS table, these rates that provided by the IRS, and we applied the depreciation technique of the MACRS to calculate and to develop this depreciation table. Now, what we need to do is, I'm going to go back to the last example that I want to share with you here, which is related to the real estate, and see how we could conduct the depreciation for a real estate asset. So that is in example 6. On example 6, Bemidji Property Management has built a new apartment complex for $2 million. Develop depreciation schedule for their property using the MACRS method. Please note that the recovery period for this asset is 39 years. What is the book value for the asset after 20 years? All right, so what we need to do is build the depreciation table showing the book value. So on year 1, the depreciation value by the end of the year would be $2 million. That's how much cost them the apartment, the complex, times the 1.391%. So the value of the asset will decrease by 27,820 after the year 1. And now for year 2 all the way to 39, again, we're using this rates right here, which is on year 1, we have 1.39. Year 2 to 39 would be 2.564. Excuse me. And year 4 would be 1.177. So we use these rates and we apply them to this example. So in year 2 to 39 would be 2 million times 2.56%, which basically saying this asset will the value of this asset will be reduced by 51,280 every year from year 2 to 39. The last year, which is year 40, the asset will be reduced by 2 million times 1.17. The value of the asset now is reduced by 35,400 for year 40. And now, in order to find out the book value for the asset after 20 years, would be the 2 million minus all the depreciation values from year 1 to year 20. We know that the depreciation value in year 1 was 27,820, plus the depreciation value from year 2 to 20 would be 51,280 for each year. So you multiply it by 19, and that would give you about the depreciation rate from year 1 to the end of year 20 would be about 1 million. So you subtract 2 million minus 1 million, that will give you the book value for this complex to be about 1 million. And that's the end of this chapter here. What I want to do is see if we could share with you the depreciation schedule for this example using Excel. So I show you how to do the calculation. Let's go ahead and implement that using Excel. So I have this 2 million started as a book value for this asset, for this complex, and then we reduce the depreciation rate by 1.39 on the first year, and then from year 2 all the way to year 39, the asset will be reduced by 2.5%, and on the last year, year 40, would be 1.17. So 2 million times the 1.39, we find the depreciation value for that year, and then we subtracted the book value. To find the book value, we subtract the book value from previous year minus the depreciation value. We conducted that. At the end of that 4 years, this asset will worth nothing on the book, but basically. And to answer the question, what would be the book value on year 20, would be the same result as we calculated which is about 1 million here, just following the same techniques that we've learned in this chapter. All right, I hope this is helpful. That's the end of this chapter. There are other videos available for you on the channel, so please go ahead and take a look into that. And if you have any question, please email me and I would be happy to help you. Good luck. Bye.